Welcome, everyone, to the Street Pros Stocks and Markets podcast. I'm Jason Meshnick, and I'll be your host today for a podcast takeover. This is our second podcast takeover of the year, and I'm looking forward to doing more of these, taking over for Chris Versace. This time, we're going to wrap up 2025 and give you a preview of 2026. And I'm putting Chris Versace in the hot seat, along with four of my favorite contributors. We've got with us today Helene Meisler, Stephen Guilfoyle, Jim DePorre, and Louis Llanes. Our agenda, what we're going to do is we're going to kick it off with Helene, who's going to give us a market update. She's going to tell us where the market is at and what she'll be looking for as we enter 2026. Then we're going to move on to a round robin of sorts with the following questions. What surprised you the most in 2025? If given the chance, what would you have done differently during the year? Third is, what industry or sector do you think will surprise to the upside in 2026? And our last question is going to be the big one. Name one stock to buy going into 2026 and one that you would sell to fund that trade. We'll go around the horn with each question and collect our answers before moving on to the next question. However, first, I have a very special announcement. TheStreet Pro was recently acquired by TipRanks. We're going to maintain a close relationship with our friends over at The Street. However, we're really excited for improvements and new benefits coming to our subscribers. So if you're not a subscriber, please hit that subscribe button and join us, because I think 2026 is going to be the best year yet for The Street Pro. Let us kick it over to Helene to give us her market update.
Okay, thanks, Jason. All right, what I've been writing about recently is that the market had a shift, I believe, last summer. And it started with the Magnificent Seven diverging. You started to get, and I never know which ones are exactly the right seven, but let's just call them mega cap stocks. They no longer moved in a block. They stopped moving as a group. And that was, to me, the biggest change in the market. And a lot of stocks peaked in July and August, not just the mags, all stocks. And they started heading down. And a lot of them finished that correction somewhere around late November. But what we had in the process was the S&P and the major indexes being held up by the fact that the Mag 7s just kept rotating. And so they didn't, they need to all come down together in order for us to get the index down. Anyway, I think that in September, we had a major speculative blow off in a lot of names. Okay. I mean, we're talking about, and I'm sure I'm going to forget a few of them because there were so many of them. There were the penny stocks, the quantum stocks, the battery stocks, I wrote it down. Hold on. The rocket stocks. Did I say quantum? I can't remember. Even Bitcoin had its day in the sun again. And what we had there was NASDAQ volume surging to over 10 billion shares a day, which is just typically you get that. Well, you don't even get 10 billion, but typically you'll get a massive surge in volume when the NASDAQ comes down or when the markets come down, because you get panic selling. What we had was panic buying. And you had a lot of these stocks up 40, 50, 60%. It was just ridiculous, in my opinion. And that all peaked in call it early October. And what we saw over the ensuing 4 to 6 weeks was the air coming out of a lot of that speculative bubble. And we got this low around Thanksgiving. We've had an oversold rally. Everybody's gotten all excited about the RSP, the equal weight, and how it's going to be so wonderful going forward. I'm not so sure. But what I can tell you right now is, well, let me just back up. I talked about NASDAQ volume. When I calculate various indicators using NASDAQ volume, I see a big peak last summer that never recaptured itself in the fall. And so, and this latest rally hasn't shown an upturn. And so, I think that's sort of the key to what's going on in the underlying technology area, which has been the hottest area of the year. Anyway, what I see going forward now is that I think we still continue to have the mega cap stocks diverging. Some will start to bottom. Very few of them have broken. They may never break, although I think some of them will. But for example, you had Meta. It really, that peaked in July. It came down, it died. And now notice in the last week, Meta is starting to hold, or the last 2 weeks, Meta is starting to hold, whereas you're starting to see Google start to roll over. So it's still this divergence that you have there. I think that continues. I think that if we get a break in NASDAQ in the first quarter of 2026, and I keep saying NASDAQ, but that's really where the weakest area is because we never made a higher high. My guess is you'll see these stocks break, you'll see them come down, and then we'll see a process through the remainder of the year where they start to bottom again. And probably in the later end of the year, the back half of the year, we'll start to see the strong stocks look better. So that's kind of what we've got. I don't expect, famous last words, I don't expect to get anything whooshy and anything as fast and furious as we saw last April. What I think we're going to get this time is going to be much more gradual. Like what we've seen lately. It's just every day, it's just a little bit more. So now in the short term, let me tell you, I think we're going to get oversold as we get closer to Christmas, and we are going to get some kind of a rally into the new year. It's after that, I think, that we go back to this problem. That's it. Oh, wait, I should talk about why I'm not so excited about all the others. I think the 493 are great. They become great trading stocks. We have a few bases there. We don't have a pile of stocks that look like bases. We have a pile of stocks that look like oversold rallies. Maybe it'll be terrific and I'm dead wrong, but that's what I see.
Helene, one quick question. Can you talk a little bit about what defines a base? Like what do you look for in a buy candidate that's been basing?
I like it when a stock has been up and down, up and down, up and down forever. I'm just going to pick some numbers, okay? A stock that trades between 50 and 80 over and over and over again, and every once in a while falls to 40. Sometimes it goes up to 90, and then it just months and months and months of that. And eventually, instead of falling down to, 50, instead of falling down to 50, it stops at 60. And the accumulation is starting a little bit higher. That's when I start to look for a stock that's going to break out. So I generally like a stock that's been dead for a long time. Nobody cares about, i.e. Google last year. Everybody hated Google and hadn't done anything for years. And then all of a sudden, look, Google came alive last summer. I like that. So I would like us to find stocks that nobody cares about anymore, i.e. the drugs, which is why I'm a big fan of the drugs. But now, of course, everybody's on the drug bandwagon, so I'm a little hesitant, but I'm still long them. So
that's the headline is Helene likes drugs.
I didn't do enough drugs this year.
What?
Hey, when it comes to the staples, the charts are not nearly as good as the drugs because they haven't done this. Just take a look at a chart of Bristol-Myers and you'll know exactly what I'm talking about. The stock came down and now it's broken out. But I don't have that in the staples. What I have in the staples looks to me just like a nice oversold rally. Then you're going to run into resistance. And then perhaps the staples can start to do this for maybe the first half of 2026.
I have one other quick question. So, Helene, it sounds like a lot of your, I'm not going to call it a forecast, but a lot of what you're saying around your thoughts for 2026 look like the second year of a presidential cycle. Is that accurate?
Oh,
Am I remembering that correctly? Because I don't know.
that's seasonality, and I'm not
Yeah.
sure because
Okay.
I don't do seasonality. But I think the second year of a presidential cycle, with Sarge probably knows that the second year of a presidential cycle is generally not good in the first half and good in the second half. Am I right?
I think if it looks like we'll have a split legislature, it's usually considered a positive.
Okay.
Okay.
I didn't know that. See, I have no idea. I'm just looking at charts, and so I can tell you that a lot of the stocks that as I call it, control the index, have made lower highs, not higher highs, and usually lower highs need to be worked out.
Right.
Can I ask Helene a question?
Mm-hmm.
Absolutely.
Okay. And I do a lot of technical analysis, but you're really the pro. Do you consider, given that the way algorithms have replaced us humans over the years, do you still consider volume-based confirmations of technical movements as accurate as they once were?
Okay, so I have always been a fan that high volume on a down move is bullish, and I know that's not conventional wisdom. Maybe it's now, but for the longest time, I was like, I don't care. We could rally and rally and rally on low volume. Who cares? Doesn't matter to me. I know conventional wisdom is you want to rally on high volume. To me, I like to look at volume when it gets extraordinary. That means either extraordinary on a down move or extraordinary on an up move. It means we're getting some level of panic. And like I said, back in September, October, I thought it was panic to get in. And in April, it was panic to get out. And so in that respect, I still think volume matters. On a day-to-day basis, doesn't matter. Not to me. Overall, though, when I do it using my indicators for NASDAQ, I don't like breadth, the AD line, because I just think it's so skewed because, as I'm fond of saying, it's where failed IPOs go to die. And so every stock that doesn't even matter gets counted. And so you get these really skewed breadth data on NASDAQ. Like, a stock is up a penny. Who cares? But that's why I started using volume for a lot of my indicators on NASDAQ. And let me give you a little thing. In the last 10 trading days, volume on NASDAQ, volume, up minus down, has been positive for 7 of those days. And yet my smoothed out indicators can't rally. So yeah, I think that matters. Does that answer your question?
Yeah, no, it's actually those 7 or 10 days is partly what provoked my question, because I did notice that as well.
Right, and still NASDAQ couldn't really go anywhere, right?
Right, yeah, no, NASDAQ's barely hanging on to its 50-day right now. I mean, it's got like 1 foot on the 50-day and it's hanging by a thread,
Right, and it's been really the weakest index.
No, it has, no doubt.
All right.
Let me just. I'm sorry, I keep doing this.
Go for it.
One other thing. If NASDAQ closes red today, it will be a major change to me in pattern because NASDAQ has not had 4 red closing days since April.
And the 50-day would have been resistance.
Buyers have come in on the 4th day every single time since April. Just a little change. Anyway.
All right. That is worth watching. I'm going to take a note on that. Thank you, Helene. All right, let's move on to the round robin. I don't know if that's the right term, but that's what I'm going to call it for right now. We're just going to go around the horn, I guess, with our questions. Helene, you are off the hook for these unless you have an answer that you would like to throw in there. But otherwise, we'll go with by order of how I'm seeing everybody on the screen, Chris, and then Sarge, and then Lewis, and then Rev. So, Chris Versace, what surprised you the most in 2025?
You know, we could talk certain stocks and stuff like that, but I think probably the biggest surprise to me has been the level of GDP that we've seen really throughout the year, despite the impact of tariffs, despite the bifurcated consumer. We're sitting here looking at, even as we get additional, data as a result of the government shutdown, the November employment report wasn't great. We lost more jobs in October, but you still look at the overall, vector velocity of what these data points are telling us for GDP. Very surprised because it sure doesn't feel like a 3% economy. That's probably the biggest surprise to me.
Okay. Sarge.
All right. Other than the New York Mets missing the playoffs after having the best record in baseball in June, what surprised me in 2025 was the length of the government shutdown, how long the Fed dragged on with their quantitative tightening program, because that was a mistake, how long it took Jerome Powell and his cronies at the FOMC to realize what they were looking at, because that now we know after today's data that was a mistake. And also that all 11 S&P 500 sectors are still trading in the green, even though we've had this little sell-off here in December. For the year, they're trading in the green for the year.
Yeah, amazing. Okay, Lewis.
Well, I believe a lot of what I'm going to say is a lot what Chris said. I was really surprised that given the stretched valuations, the tariff uncertainty, interest rate uncertainty, geopolitical events, it's amazing at how resilient the market has been. And the mega caps, really outperforming, technically rhymes with other, cycles that I remember in my career. And just the trend is your friend until it bends at the end, they say. And I think that's kind of what we're in. It's everybody's kind of looking at each other. And we all know that certain stocks that have very good fundamentals are stretched, but we keep buying them. And I think that's the mode generally where we are in the stock market. And as I was listening to Helene, I'm still surprised, but luckily discipline keeps you in the market. But yeah, you could. I think it could be a big mistake to sell out a lot of times in these kind of markets too soon. So
Yeah, I think that's the most important thing is discipline, right? Have a process and work your process. And if your process
absolutely,
isn't working, figure out a different process. But
exactly.
start there. Okay, thank you. Rev?
I would say the most surprising thing in the past year has been the great concentration in the mega caps and how that has caused the indices to distort what was really going on with the majority of the market. There was a lot of poor action that was hidden behind the indexes. And there were areas where there was great themes and things like quantum computers and rockets and so on that Elaine mentioned, but that was fairly narrow, and the whole market was basically focused on those mega caps the whole time, and stock picking was not as effective as it should have been in a lot of cases. I mean, you can get in a lot of trouble in a good stock simply because it isn't a mega cap that was driving the indices. And a lot of times the indices would send the message that, oh, yeah, this is a great market, when a lot of stocks were not participating. So that always happens to some degree, but I think in the past year it was to a much greater extent than we normally have seen in the past.
Yeah, I think that's true. I remember a year ago when we had Doug Cass on the prior version of this, so not the podcast, but the live quarterly call, and I asked him, so Doug, what's your call for the year for 2025? Given that he was so bearish right during that time, and he said, well, it doesn't matter what I think. The mega caps are doing well. You just have to continue with those, right? He was effectively calling for just stay the course, right? Trend is your friend, like Lewis said, and so that was turned out to be the right call as well, at least for the first part of the year. Okay, let's move on to question number 2. Given the chance, what would you have done differently in 2025? And let's start right back with Mr. Versace.
I think if I could go back in a little time machine and whisper in my ear, maybe middle of the year, maybe even the start of the year, I would have introduced the EPS diplomats model strategy into the portfolio much sooner than we did. We only pulled the trigger, as we like to say, on bringing that into the portfolio in the middle of November. It's performed extremely well, and for folks who aren't familiar with this is a backward look at the top 8 companies poised to deliver EPS growth in a consistent fashion, in a double-digit fashion, and the basket gets reconstituted once a quarter. And like I said, we brought these 8 stocks in mid-November, and they've outperformed the S&P 500 in a very strong fashion. Looking at the data going back, we would have had even better performance if we started the model earlier in the year. So that's the one thing that if I could go back in time, I would change.
And I will make sure that that is noted, that we have a link back to the article where you first talk about those and added those into the Street Pro portfolio. Yeah. Okay. Sarge, what would you like to go back and change?
Well, I had no exposure to utilities this year, and the XLU ended up being the 4th best performing sector for the year. I think they're up 15 or 16%, something like that. And so I had no exposure to a dividend paying space that actually did well in the market as well. So that kind of ticks me off a little bit. And as Helene is heavily exposed to pharma right now, I was very lightly exposed to pharma this year. I mean, I was in Lilly for a good portion of the run, and I traded it well when it was going back and forth. But outside of Lilly, I wasn't really in pharma. And I think the Dow Jones U.S. Pharmaceutical Index is up like 22 or 23% for the year. So, how you always go to the machines in the gym that you're good at and stuff like that. Well, I didn't really trade the sectors I wasn't good at, and I really should have been involved in those 2 sectors this year.
So you
Hey,
skipped leg day.
Yeah, I skipped leg day.
Sarge, I just saw a great statistic this morning that in the last 4 months, if you look at all the sectors of the market, the healthcare sector is by far outperforming everything.
Yeah, well, I can go to 3 months right now without doing any extra work, and it's the top dog for 3 months easily.
Right. So if you go to 4, it's
Yeah.
still up there. In other words, if you go to 4, you're taking out, you're even including before they started running.
Yeah, no, congratulations.
All right. Lewis.
First of all, I love to hear these technical discussions that you guys probably don't know, but I'm a pretty hardcore technician myself. I try to keep it under wraps, but I really am.
And I should say that's how Lewis and I met and became friends, is that Lewis and I ran the Denver chapter of the CMT Association for many years. I think I'm the only one who's left running it, but at some point we'll have a meeting.
Yeah, I live in Austin,
Anyway.
so I wash my hands and
Yeah.
but it's great. I need to get involved here, but I wanted to make a quick comment about volume. Actually, I've done quite a bit of studies on volume in terms of in recent years, and the volume. You're exactly right, Helene. It's the quantity of volume. I mean, quantity. You can go back and actually back test it. It's how much volume that's happening and what's the price doing at that time. And actually, buying on heavy volume actually is a negative expectancy in the next near term. 1 month, 2 months, 3 months, like quantitatively. So and it has a decay to it, but actually quiet is the best time to buy. Quiet and not a lot of volatility, which fits right into what you talked about.
That's my back test.
And your back test is better than any quant. I love it. You know what? Where's my ruler? I'm going back to the ruler. So let's see. What was the question again? What would I? Oh, I know what.
Yeah. What would you have done differently?
The first thing I thought of when I saw this question was that song "Breaking Up Is Hard to Do." You remember that one? They say that breaking up's hard to do. Now I know
Frankie Valli.
Yeah, that was Neil Sedaka wrote.
Sedaka.
So, and the reason why is because I let taxes wag the tail a little too much. You know what I'm saying? And I need to get back to my trim versus sell discipline, which is very nuanced. But that protecting a profit is oftentimes more important than it is for you to be worried about your tax concerns, even though they're big dollar amounts that you got to pay in taxes. And it's a hard pill to swallow. But I've had multiple instances in the past 12 months where that has proved to be a net negative on my decision making. So I would go back and work on my trim versus sell. Trim when you have something where the business is intact, but it's just stretched, and sell when the business is not intact, and use your technical. So that would be my biggest mistake, I would say, for the year.
Great.
Hey, Jason, can I squeeze a question in just kind of for the group here, just based on what Lewis said? I know Sarge has certain fixed rules. Stocks pull back a certain amount, he will either trim or exit the position. Does anybody else have any other rules for when you will trim in a positive sense relative to, say, a position size?
Well, I mean, if you want to go back to me, it's not just my 8% rule when stocks are doing poorly, but I also take something off every time one of my target prices is reached. So that way I can't say, oh, I should have sold it when I hit my target. What a moron. Because I learned early in my career that sometimes I can be a moron. So when I do hit targets, I do take something off. And if it comes back into to what I see as a technical level where I should be buying it, then I'll put the portion back on that I took off.
Right, but if it runs in like for the portfolio, we say if it hits 4.5% position size, because we've got 25 to, if we include that EPS dividend model, about 32, 33 stocks. So we've got to be a little careful in terms of our sizing. So for us, if it comes over the 4.5%, members know that, especially if it's overbought, we will likely be trimming some profits out, rebuilding our cash or just redeploying it elsewhere. Do you have anything like that, Sarge, Rev, or Lewis, or anybody else?
I used to do that. I used to keep all my positions under 5%.
Let me say that what I do with my positions is I trade them all in multiple time frames. So rather than just having a set rule, I think about it as each stock in a long-term frame, a short-term frame, and so on. And that way, my position sizes are always going up or down depending on the longer term or short term technical conditions that have developed. And that way, I don't just have a set rule that I handle the whole portfolio in that manner. It's just a subset of each position gets treated a little bit differently. So my rules get very complex, because I'm using multiple time frames plus some parameters to also cut or to expand positions as conditions change. So it's a little bit of subjectivity involved in it, but I try to keep it objective to some extent.
Yeah. If I could just add, you had mentioned that you kept your position size to a certain constraint. One of the things I found that's useful is to not base it just on the position size, but base it on the contribution to risk to the portfolio. So I could have a position size of 5%, and if the stock is, average volatility is a lot higher, then you want to pare it back. So I have a similar rule, but if the concentration, if the contribution to risk gets out of whack, that's a hard and fast discipline that I use. And regardless of taxes, the mistake I made with taxes was more discretionary oriented. But on the if something gets way out of whack, like I reduced my gold position, even though I'm bullish on gold, and people were telling me that I was crazy. But it was just pure risk management. It had nothing to do with I don't like gold anymore. But I found that that's more effective than just using a position size. But that's just how I do it.
I was just going to say, I find that if you take something off like Sarge, when it hits your target, you have no regrets if it goes down and it doesn't stop where you think it's going to.
No. And I wanted to add to what Chris said about position size, and I sort of agreed to for most of my career. I do break that rule at times. Like last year, 2024, when I realized with Palantir that I had a tiger by the tail, I let that thing become a massive portion of my portfolio because I realized that was the key to my year. So, I mean, I will try to use my head and when it's appropriate, when I think it's appropriate, and break my rule.
Have rules, but break them when appropriate.
Well, and you'll be wrong sometimes. So it's not a rule, right? But it's a guideline, and once in a while you have something special like that. I mean, I was my best trade in about 30 years, so I had to let it go.
That's why we draw
Yeah,
thick lines.
exactly.
And we have erasers.
All right. In the interest of time, Rev, let's move on to you with the same question. Given the chance, what would you have done differently in 2025?
Well, the first thing that I would do is only pick stocks that go up. That is the main change that I would make. So,
Okay.
other than that, but really the main thing, I'm always tinkering with my style in the way that I approach the market. I think in the past year, the one thing that I learned that I need to do more effectively is to have concentrated positions in the best stocks and make those positions big. Just like Sarge just mentioned, he knew he had a winner there, and he stayed big and stayed with it. And that's the mistake I think too often. You want to take that profit, put the ring register, make sure you got it on the books, and I should have been much more aggressive with the winners that I had, and been more concentrated. And I think I get over diversified sometimes because I'm looking at too many little small stocks and waiting for them to produce and so on. And that's one of the things that I'm going to change or work on in 2026 is staying very focused on the winning sectors and themes and so on.
Sounds great. Um, and Sarge, I know it sounds like your dog may have some regrets in 2025. Wants
Oh,
to share.
well, we had a guy
Uh,
fixing the air conditioner. So
okay. All right. So let's move on to our third question. This one's forward looking. So we're moving from being backward looking to being forward looking. What industry or sector do you think will surprise to the upside in 2026? And we won't start with Sarge's dog, but let's start with Chris Versace instead.
Hopefully, a somewhat smarter answer will I have. So as we sit here towards the end of December, I think there's a lot of questions over what's happening on the AI front. Whether how some of these massive deals are going to get funded. Are the capex levels going to be needed that we've seen just getting stepped higher and higher? And these are all the things that have led many of us to be bullish on whether it's Nvidia, Marvell, or even Sarge and Palantir. And the way I've talked about it and I've written about this is, we are going to continue to follow adoption and usage. And I think there are things that are happening with enterprise adoption and soon in 2026 on consumer adoption of AI that I think is really going to drive greater demand for digital infrastructure. That is data centers, that is chips, that is servers. So I think that as we, revisit this conversation in 12 months, I think these names, even Broadcom that has been falling off of late, I think the vast majority of these will be higher 12 months from now. And some of what I'm talking about really ties back, not just some of the big announcements we've heard, but even some of the maybe not as high profile ones. Like for example, one of the ones I'm thinking about, and I've written about this, is the OpenAI and Disney tie-up to use the Disney characters in short form AI generated video with OpenAI's platform Sora. And the reason I really stepped back and thought hard about this is because it has the potential to drive AI usage from a simple text query on ChatGPT or Anthropic, what have you, to much richer, more robust, much data being used, video. And if we think about how we have seen data content creation, consumption, and data traffic evolve really over the last 20 to 25 years. First from simple texting to apps to streaming video to streaming video calls. That push into the richer applications, especially video, it drives tremendous data consumption. So I would argue that Here today we're concerned about it, but if we see this video adoption happen in AI, if we see it happen on the consumer side as well, once Gemini, which is Google's tool, powers this new AI-enabled Siri on iPhone, and then we get the competitive response, I think what we're seeing today, people will look back and go, wow, that was a time to pick up some of these names.
Great, thank you. Sarge?
All right, from a business sense, I think the real place to be is going to be nuclear power, like SMR, like Oklo, but they don't have any sales yet. These companies, so they're overvalued. The stocks are overvalued. From a stock market point of view, I'm thinking as AI becomes more democratized, as the AI trade broadens away from infrastructure and towards the industries that may benefit, I think I like the financials. I think banks large and small. I think net interest margin is going to expand and the investment banking opportunities are going to be there. There's going to be increased productivity, increased efficiency. And I think this is a group that's still priced relatively affordably. And I think this is where I'm going to start focusing, at least in the earlier part of the year, as I set up for my year at Lang.
I love it. So we've got AI infrastructure moving on to one of the main consumers and how they'll benefit. I'll
JP
definitely be
Morgan
watching.
going off the top.
Yeah,
Great.
I'm in
All
it.
right. See,
Let's take a look.
the charts don't lie.
I think they were overbought up here. Anyway.
Yeah, I'm actually intending to sell some, to tell you the truth.
All right. Lewis.
I agree with both Chris and Sarge. So I'm gonna flank to it my third point because they have the same points that I was going to make. But actually, one of the things that I do is I have you may have heard I have this concept I call TORC, which is a technical term: trend, overbought, oversold, relative performance, and quality patterns. So I analyze the sectors based on that, and then I have a basic fundamental scores that I look at the sectors from a bottom up level. And so I kind of rank them. And actually, the one that's number 3 in the third slot that I think could surprise people even more so would be a rebound play in real estate. Financials is also in that actual scoring. So financials, by the way, has a score of 7.8 out of 10 in my criteria, and real estate has a slightly better 8.2 out of 10. And I'm looking at like what are the trends, what is the relative performance, and whether or not it's turning. What is the valuations on the priced funds of operation? There's many different angles that I'm looking at it, but overall, quantitatively, that particular sector looks like it could be a surprise, surprise some people on the upside. The data center stocks also fit in that category, but the financials, I think, is also another significant one there. And I do agree. I feel like when you kind of put a mosaic of what Helene's saying, and we have this potential of a drop. With kind of the darlings that everybody loves right now, but the fundamentals are still in play, like Broadcom. I completely agree with that, and that's when you can pick them up. But that overbought level seems to be the theme right now. So I'm looking for places to put money now that can help, rather than just having a bunch of dry powder.
Are you looking at housing or like the REITs?
Looking at the REITs.
Because the REITs are one of those charts, Jason, that have just done this all year long. And I keep waiting, thinking, one of these days they're going to go up, and they never go up.
And if you look at them on a bottom-up basis, too, which I know you do, one of the things I like to look is those RRG charts. I don't know if are familiar with those, but it's a rotational chart. So you could see the relative performance versus an index, but you can also see the change of that over time, and you can see it has like a tail, so you can see the path of it, and you have this rotation that happens, and you can see the financials have gone from the underperformed to the risings, and so has the healthcare, and so has the financials. And I think what's going to happen is that when the darlings sell off, that rotation will go in those sectors. They probably have some upside there you can make money on, but the real long-term fundamental growth engine is still the stocks that I believe that Chris is talking about. We just need them to come down, I think, in my opinion.
Great. And for those not familiar, RRG stands for relative rotation graphs. And I think they're about 15 years old. pretty cool way of looking at relative strength analysis. Because again, yeah, you get that strength as well as the momentum of the strength. I'll try to link that in the notes as well. Rev, let's move on to you. So, what industry or sector do you think will surprise?
Well, I think both Chris and Sarge have good points about AI and power. And I think you have to look at some of the niches there rather than the overall themes. Like in power, I think some of the niche stuff like edge computing, some of the alternative energy things, solar or whatever, will be areas that really do well. One group that is sort of talking my book that I think will do well in 2026 is biotechnology. Biotech has been under a lot of pressure because of FDA. You've had all that craziness going on there for a while. It's underperformed for years. It's been a terrible, terrible group for a long time. And it's finally started coming alive in the last few months. It's done very well. It had good relative strength and so on. And I foresee that continuing. There's going to be a lot more merger and acquisition activity in that group. The big drug companies, the way they do an R&D is to acquire little biotechs. That's where their R&D comes from. And I think that the group will start getting a little more respect when they start showing some relative strength, and that's going to suck some more people into that. And there's also a lot of AI plays in the biotech sector. There's AI implications in a lot of these little biotech stocks that is going to start coming to the forefront in the next year or so.
Awesome. Yes. The only concerning thing I've heard so far is that everyone seems to be in agreement on AI.
Not me.
So, except for Helene. Good.
No,
All right.
but that's my nature. That's my nature. Come on. When everybody starts to say, oh, we have too much of this and too much of that, and it's awful and it's terrible, I'll probably be like, I don't know, AI's not so bad.
4 out of 5 market analysts agree.
As long as it's not dentists and foreigners.
Right. Okay. Last one. This is the big one that everyone's been waiting for. Let's name one stock to buy going into 2026 and the big one that you would sell to fund that purchase. Again, starting with Mr. Versace.
Yeah, so I'm going to make this pretty quick. We are in the portfolio looking to buy some Broadcom. And as we've communicated, we would trim back some of our existing chip holdings. The one that I would probably trim the most out of to fund this buy would be Qualcomm.
Okay. Buy Broadcom, sell Qualcomm. I'm writing these down. Sarge.
Okay, well, I can't just give you one. So these are my two in my mind setups. Okay, I'm going to increase my long exposure to SoFi, which is already a big one. I'm going to reinitiate Wells Fargo. I'm going to do that at the expense of JP Morgan. On the tech side, plus AMD, plus Broadcom, initiate Amazon, and that's at the expense of CrowdStrike, Intel, and NVIDIA.
So CrowdStrike, NVIDIA. Okay. What was the last one?
Right. I'm not getting out of those stocks. I'm reducing them.
To fund. Right. Okay. All right, Lewis, let's move on to you.
Okay, I'm going to give you something that's quite boring. Dutch Brothers. Buy Dutch Brothers. They've got a great growth story. They could double the number of stores that they have, drive-throughs. My daughter, I went to a football game. My daughter said, hey, we got to go to Dutch Brothers. And I started looking at the fundamentals. I'm like, whoa, this has some nice growth potential. Nice chart, by the way, as well. And I would just sell Starbucks. That's an easy one. Even though Starbucks, you can make a case for owning it, I do think it'll outperform in the next 12 months. We'll see.
You can make a case that Starbucks has done this.
Yeah.
Yes.
For the longest time.
Yeah.
And the coffee's not that good.
Okay, and Lewis, you just wrote an article about Dutch Brothers, so I'm going to make sure to link that as well. All right, awesome. Rev.
Well, I always have a hard time with this question because I don't trade portfolios like you guys do. I just don't handle the market in the same way. the way I look at this picking a stock for the year ahead is I want something with the biggest return. Something that's going to have a giant return, and that you have to take into account your tolerance for risk when you're picking stocks in that way. If you don't want any risk, then I'd go with a big cap. I'd pick an Amazon, or an alternative to that I'm kind of thinking would be a good longer term buy and hold is Uber. I think Uber is a contrarian play at this point, and that it's gotten too much pressure on it because of the fear of competition from Tesla. And it's also getting the FTCs going after them on all this other stuff. So they have a pile of bad news, and I think it's getting overly sold because of that. Thought that was what I would do in a longer term balanced portfolio. If I was going to pick a risky stock, I'd go with one of my biotechs. Last year I picked Xerox, XERS, which more than doubled throughout the course of the year. This year I got two biotechs that I'm looking at. One's called Alto Neuroscience, ANRO, and what they do is precision psychiatric medication. What they do is they take drugs for antidepressant or for schizophrenia, and it's made to fit the exact bio makeup of those individuals that need those drugs. And they try to make it precisely formulated so that it deals with it. It's not a one-size-fits-all psychiatric drug. And that's one name I'd pick. The other one is Delcath, DELCATH. The symbol is DCTH. They're in oncology. They treat liver cancer primarily. And they have a system where blood is taken as it comes out of the liver, and it's into a device that's external to the body that filters the blood and then puts it back into the system, and it takes out all of the chemotherapy stuff, so it doesn't go through your system. It just goes through your liver or whatever is needed. It's a very complicated process. It requires a lot of medical staff, specialists and so on. And it's kind of been slow on the uptake, but I think this is the year where they're going to really start to prove what they do. And there's a lot of other cancers that it will work for. So those are my two small biotech picks that I have for the year. Like I said, they're high risk. The way you manage that risk is you trade. You got to trade them, and that's how you manage your risk. If you want to buy and hold something longer, I'd go with a Uber, or maybe I think Amazon and the Magnificent Seven is the one that I think is going to outperform in the year ahead.
Awesome. That was great. Thank you. With that, does anybody have any final words they'd like to say? Okay. Well, I just want to wrap things up by saying thank you so much. This has been a really good conversation. I wish we could make it 5 times as long, and we could spend all this time with everybody. So I just want to say thank you to everyone for all your hard work in 2025, and I'm really excited and optimistic for all the changes in 2026. It's going to be great. The only other thing that I want to say, and I keep forgetting to say this, is that this podcast can be found on all of your major podcast channels. It's also available on YouTube. We're actually migrating it right now, so this one will be up on our new YouTube platform, which I believe will be called TheStreet Pro Video. I will put that in the article that we publish this on, so everybody can like and subscribe and continue to follow along with the conversation. And also remember that if you're listening now, you can leave a comment for everybody, and people, especially on this call, are really good about answering people's comments and responding. So we want to make this as much of a two-way conversation as possible, and it doesn't have to end with just when we turn off the video here. So thank you for everyone for participating. Thank you to everyone for watching. And again, I'm very excited for all that's to come in 2026.
Rock on.
Thank you.
Thank you.
Thank you.